Welcome to the NISM Masterclass. I am your host, Sashi Krishnan. As part of our purpose at NISM, which is basically capacity building for the securities market ecosystem, we sit down with the gurus of the securities market to understand and learn from their journey. I'm sure all of you who join us in this masterclass will gain significant knowledge from the conversation that we are going to have today. And my guest today is Saurabh Mukherjea. Saurabh is the founder and the chief investment officer of Marcellus Investment Managers. And for those of you who don't know what Marcellus means, it basically means in Latin, young warrior, yes, if I'm not mistaken. And there is little doubt that Saurabh and his team are doing everything to defend and protect the interests of investors in this market.
Thank you.
Welcome to this masterclass, Saurabh. Marcellus today runs 7 PMS schemes and manages something like 6,700 crores of rupees with around 4,500 investors. And Saurabh has also wears other hats. He was an active member of the Association of Portfolio Managers, that's APME, where he was a founder director. And he's also a prolific writer. And maybe sometime towards the end of this conversation, we will sort of, get back to discussing, one of Saurabh's latest books. So Saurabh, to begin with, I just want to draw your attention to a conversation that we had in 2014, where you were the CEO institutional equity at Ambit Capital. And I think that was around the time when you also launched your first book, if I remember, Gurus of Chaos.
Yes.
And at that point of time, you had come and made a presentation to me saying that, the Nifty index churn seems to suggest that the Nifty churns almost 50% every decade. Mm-hmm. And which would basically mean that, there is a 50% probability that the stock will not be on the Nifty in the next 10 years. And maybe, in the next 20 years, maybe a 75% probability that it will not be there in the index, right? And therefore, if you look at the Nifty 50 itself, there are barely around 10 stocks. I remember that study seemed to suggest that, were 25 baggers. Most of the other stocks really didn't give you that kind of return. So, Warren Buffett put it very succinctly that, you just have to be right a very, very few number of times, right? And, the big idea is not to be, very seriously wrong or make any big mistakes, over the lifetime of managing a portfolio. So my question to you is, as a portfolio manager, how do you achieve that?
Right. So there's a couple of aspects of the Nifty's construction, and indeed, I think of the Indian stock market's construction, which I think are interesting. They create risks and opportunities. And back in 2014, Sashi, your remarkable memory is bang on. There were two aspects of the Nifty's construction which we had sort of highlighted. One was this 50% churn in a decade. And the other was the fact that the Indian economy, the composition of the Indian economy and that of the Nifty didn't quite sync up, right? So let me just dwell on these two in turn. Now, if an index is high churn, 50% in the case, Nifty's case, and you as a fund manager are on the wrong side of that churn. You buy something, you buy a company which gets churned out, then naturally the odds are pretty high. The data suggests the odds are pretty high, you'll underperform the index, right? And then to invert that point, if you buy a stock which is not in the Nifty and the company makes it in, you almost inevitably outperform the index, right? So that's the first way we have tried to understand this, both for the Nifty and especially for the BSE 500, which also has similar levels of churn, right? If you're able to catch an entrant into the BSE 500, in the 3-year run-up to its entering, you end up getting alpha of around 30-40%.
If I may interrupt out here, if it's the same for the BSE 500, you mean to say 250 stocks actually exit the BSE 500?
So over a decade, in a typical year, therefore, anywhere between 20 to 40 companies go in and out, right? And the rewards of getting an entrant, rewards of correctly second-guessing an entrant to the BSE 500 and getting it into your portfolio 2 to 3 years prior to its entering are very high, right? And early on, 6 years ago, when we set up Marcellus, we ran a crunch on this data that in turn led to something called the Little Champs portfolio. And for 3-4 years, we were able to get this dynamic pretty bang on, right? So that's the first aspect. Churn creates this risk, but it also creates opportunity, right? The other aspect that the stock market and the economy are not synchronous, I think, is again a risk and an opportunity. So for example, at the highest level, 60% of Indian GDP is services.
Right.
But if you look at the stock market, 60% of the stock market is not services, right?
Mm-hmm.
Stock markets are, the services representation of the markets is south of 50.
Right.
And therefore, if you believe you've identified a big chunk of the economy, which is not in the stock market currently, and if you have the clarity of thought to identify high quality companies and load up on that, then in due course, as the stock market gradually reflects the economy, you should get outsized returns from that.
So if I may interrupt again out here, are you trying to say that a lot of these services companies are not listed yet and are potentially companies that will get listed in the market?
Yeah. So both there are companies who are not listed yet. In my latest book, Behold the Leviathan, in the last chapter, I highlighted this, that the big chunk of India's fastest growing companies are not in the stock market. And the other aspect is they might be in the stock market, but they might be undervalued. The market might be saying, yes, this is a service provider, but hey, we've got better things to value, so let's undervalue this company. But you can see in the real economy, that element of services is a big chunk of the economy, but it's underrepresented in the market, and therefore you load up on it, right? And one way to understand this disconnect is if you look at, say, Q2 FY25 earnings growth, it's around -5%, right? Nominal GDP growth is growing at +10%. Right? And the reason for this sort of extreme divergence is that the stock market and the economy in India don't actually sync up very tightly, and that's because the indices don't represent the economy in sort of perfection. Broadly, the index represents the economy, but not in sort of perfection.
And that's where the opportunities are.
That's exactly where the opportunities are.
Okay, so you've said that your philosophy, your investment philosophy is basically to invest into high quality companies with strong corporate governance, prudent capital allocation and sustainable competitive advantage, and hold them for the long period of time, right? So 2 questions out there. So, what are those 2-3 characteristics of high quality companies? Because basically, see, every portfolio manager, at the end of the day, every fund manager is paid to identify these high quality companies, right? But unfortunately, 60% of them don't outperform the index.
Yeah.
So that was question number 1. And question number 2 was about these long periods of time. Unfortunately, it's not for you to decide what's a long period of time, right? People are giving you money to manage, and clearly there isn't, their thinking of long period is not synchronous with your thinking of long periods. How do you manage that dilemma?
Sure. So let's start with the easier part of your question, which is what is a high quality company? So in Diamonds in the Dust, this is a book we published 3 years ago, Sashi. In Diamonds in the Dust, we broke this down into 3 pillars, right? We first started with governance and accounting quality, and we broke that down into 11 accounting metrics. So for example, if a listed entity has its auditor's fees growing faster than its revenues over a 6-year cycle, then it gets a negative mark in our accounting score. Similarly, if a listed entity's conversion of operating profit into operating cash, if that conversion is subpar, it gets a negative mark in our accounting construct. So in Diamonds in the Dust, we've laid out 11 such metrics. We've given lots of case studies of companies who fell foul of these metrics, and either the promoter ended up in prison or they ran away to London, something along those lines. Right? And plenty of examples about how accounting quality should be looked at. Right. And by the way, it's still very relevant in India. In a typical 6-year stock market cycle, 2 years, the stock market inevitably falls in love with companies with low quality governance. Then there's a blow up, then people revert to quality. So it's one of those life lessons almost, right? A bit like heaven and hell. We keep cycling in India between high quality and low quality companies in the stock market I've seen.
So if I may interject out here, I was reading this Ernst & Young study,
yes, sir,
which was about the Global Integrity Report, the India edition. And, it seems to have some very disturbing fact which says that 30% of, Indian companies anyway are prone to, not only misleading investors, but misleading their auditors, misleading the regulators, misleading their own boards and board committees also. And, you have been talking about, I need to crush risk if I need to identify these, financial accounting frauds, whether they're revenue risk or they're accounting risks or whatever it is. So, whereas, if 30% of those companies in India, listed or unlisted, are, let us say, suspect, then how do you then actually get to identifying or get into a universe of companies that you can invest into?
Right. So our work suggests it's more like 40%. Okay. So out of, say, the top 1,000 companies in India.
So that's more than 30% that E&Y suggests. 40% is a nice number.
Our number is 40%. And So out of the top 1,000 listed stocks, around 400 are naughty in inverted
Right.
commas, and we let them be.
Right.
If the fact that they're naughty per se is not the problem.
Right.
The fact that they are naughty and yet in a 6-year stock market cycle, 2 years these naughty companies have a great run. That's the core of the challenge in the stock market, right?
Right.
If companies with poor governance had their comeuppance in poor stock price performance, we would say it's an efficient market. You and I wouldn't have to have this sort of discussion on it, right? But the challenge in our country is in a typical 6-year cycle, 2 years the naughty guys' stock prices will soar. Both retail and professional investors will park large amounts of money there. Then there'll be an almighty blow up. People will lose their shirts. There'll be all sorts of breast beating about the subject, and that's when the market will revert to quality. So what my colleagues and I have made peace with is in that 6-year cycle, for 2 years, the kind of investing we do in high quality companies with good accounting, good governance, that won't be cherished, celebrated,
Right.
and we'll probably get a few brickbats in those years. And it's my 17th year of living in India. I'm watching the same movie for the 3rd time. I have made my peace with it. Those who are new to the game will probably need to live through the couple of cycles to understand this aspect of India. At one level, this is exactly how all free markets are. America is no different. I think Japan, China, Taiwan, other large stock markets have very similar sorts of features, especially early on in a capital markets evolution. Now, there's the other aspect of quality, which is that it's not just clean accounting, but it's a formidably well-run franchise. Well-run in the sense that capital allocation is sensible. The promoter is able to allocate capital such that return on capital is above the cost of capital. So, say pre-tax ROC is above 15%. And to do that, if you're to run a business where consistently your return on capital is above cost of capital, you have to do something which is clever, thoughtful, systematic, process-oriented, in Buffettian terms, moats. Now that aspect also becomes a challenge as an economy becomes more competitive, right? So in the India of 30 years ago, where cost of capital was high, talent was scarce, infrastructure was rubbish, maintaining moats was easier. In the India of today, where digital infrastructure is world-class, cost of capital has plummeted in the last 20 years, and smart kids are popping out of colleges at the rate of 10 million a year, the moats are harder to maintain, and therefore an investor's job, a quality-centric investor's job, becomes a little harder. You need to travel more, see more companies, especially smaller companies, train yourself more to spot unappreciated beauty early on in a company's existence.
So is it, you're talking about this competitive advantage that a company has, the competitive advantage that a company has, or the moats that they build. Is it now necessary in today's world for companies to continuously reinvent themselves, either in terms of products or in terms of processes? Or is it enough for them to hunker down on, that one single competitive advantage they have, either in their product or in their market, and just build on that?
Yeah. So I think I'll draw a distinction between two types of moats, right? Moats which are around brand, around reputation, I think are slightly easier to sustain, right? And similarly, moats which are around regulatory barriers to entry, right? Say a good bank, right? A good bank has a brand and reputation, and the RBI doesn't dole out bank licenses often. So a good bank with a good reputation, good brand for looking after depositors' money, and it's in the highly regulated sector where new entry is tough, I think that's a pretty reliable moat to my mind, right? Moats which are around technology or process innovation, I think have become more contestable, more competed away in today's day and age, right? Now, if a company is in that latter type of sector where its fundamental moating is around smarter processes, better technology, what you then need to understand is the CEO or the promoter awake and alive to the fact that the world is changing and his moats could be eroded very fast, and he therefore has to make preemptive moves, right? So let's take an example. I think it was 2016 that Bhaskar Bhatt flew to Chennai. Bhaskar Bhatt, the erstwhile Titan MD, flew to Chennai and acquired Carrot Lane for roughly $100 million. I think he paid $100 million for 75%. Now, if you look back, right, I think it's a remarkable move. 2016, 2017, Tanishq, the Titan's jewelry franchise, Tanishq as a brick and mortar jewelry franchise was doing really well. They'd been through a couple of rough years due to RBI rule changes, but as a franchise, they didn't really have that much by way of large organized competition. Titan was in the midst of a journey where they would compound 1000x in 20 years. And had I been Bhaskar Bhatt at that time, would I really have wanted to use my Saturday morning to fly to Chennai, pay $100 million to a 30-year-old jewelry entrepreneur who built an online jewelry business? I probably wouldn't have had the brains to do it. But all credit to Bhaskar Bhatt for having the prescience to preempt the fact that online jewelry was going to become a big thing in India. He bought Carrot Lane for $100 million. For $100 million recently, a year ago, it has been valued at $2 billion, right? So Carrot Lane is now the most profitable online retailer in India across all categories. And not only has Titan preempted the threat of online retailing in jewelry, they've actually made money for their shareholders like me through this preemptive move, right? So in companies where the moats are around process and technology, you need to understand, is the owner, the promoter, the CEO, the trigger puller, is that guy awake and alive to these threats? And more importantly, can they preempt some of the threats and turn it into an opportunity rather than a threat?
So just another question that I had in this regard. So you have sometimes these very large companies that go on to take over smaller companies, like the example that you just gave us. And these smaller companies are a lot more nimble. They are quick decision makers. Their ability to access markets quicker through technology is very, very different from these large companies. So very often what happens is these smaller companies get absorbed into larger companies. They then adopt the same processes and the bureaucracies that these larger companies have, and you really don't get any advantage from that.
Sure. I think one of the central features of both modern American capitalism and increasingly Indian capitalism is the ability of a large company to let not just acquired smaller companies, but also to let specific divisions function autonomously without getting suffocated in bureaucracy. So in the specific case of Carrot Lane and Titan, Carrot Lane continued to be run out of Chennai by its founders. Titan continued to be run out of Bangalore by Bhaskar Bhatt and his team, and both flourished almost independently. My reading is Titan learned a few things on how to improve its own online businesses, courtesy the tricks that Carrot Lane had mastered over the years. But Carrot Lane's own functioning, its autonomy wasn't diluted. And there's a lovely book on this subject, the general subject of how can large companies empower their chieftains to run divisions with freedom within a framework of risk management, within a framework of ethics. The book is called The Outsiders by William Thorndike Jr. It discusses 6 companies who between 1970 to 2010 beat the S&P 500 by, I think, 10x or 20x. So, for example, Berkshire Hathaway is part of one of the case studies, right? Warren Buffett and Charlie Munger from headquarters with, I think, a staff of no more than 20 people run this colossal empire where they don't really interfere in the day-to-day functioning of their companies, and yet those companies seem to flourish and give shareholders in Berkshire Hathaway, such as myself, 9% dollar compounding over long periods of time.
So the second thing that you talked about was capital allocation, right? And capital allocation obviously is the most important responsibility of the CEO. I think, I don't think any portfolio manager or investment analyst has two views on that.
Right.
But my question is, it seems inconceivable to me that a company can keep up this virtuous cycle of cash generation going on into perpetuity, right?
Yeah.
So most CEOs have a status quo bias that, beyond building sustainable, advantage in their core business, where they keep reinvesting into their core business, and all excess cash goes back into the core business or the core market. They can't think beyond that. So how do you actually judge, whether the CEO or the management has the correct process for capital allocation, the correct attitude towards capital allocation?
Right. So I think 3 parts to this, right? 3 parts to the capital allocation piece. So let's start with the inner layer of the onion. The inner layer of the onion is you're running your core business, your main engine. We are expecting you to run that business where if you don't have ability to deploy capital there at ROC, return on capital of say 20% or more, you then either give it back to shareholders through a dividend or you do a buyback, right? So you return capital, right? So the first bit of discipline we're looking for is to say that if you're in your core business, growth is dwindling, penetration of the formalized piece is very high, you return money. So Colgate Palmolive in India would, I think, be the archetypical example, right? So whatever reason, toothpaste seems to be fully penetrated in India, and Colgate Palmolive, I think, does a dividend payout of 90%. The return on capital is colossal, I think 120, 130, but they return the bulk of their money to shareholders. That's the first basic piece. And the second piece is to say that yes, my core is kind of saturated in the sense that penetration is high there. But hey, I believe I have spotted adjacencies where I can use my traditional strengths.
Let me interrupt out here. Why adjacencies? Why not something completely different?
Right, because completely different means you have to teach yourself a completely new rule book, right? To the extent new rule books are going to be tricky to master, we would rather you do a adjacency, right?
Okay.
So an example of this would be Pidilite circa 2000. So roughly 1970 to 2000, Pidilite spent 30 years and they ended up dominating the white glue category, right? The traditional Fevicol wala category, right? And by 2000, they were generating surplus cash and they seem to have saturated the Fevicol opportunity. So that year, Madhukar Parekh ji bought from Mahindra and Mahindra Dr. Fixit, right? They bought couple of brands, I think Dr. Fixit and perhaps a couple more. They paid, from what I recall, 50 to 100 crores for it. They had enough surplus cash from the Fevicol wala business to buy this. And then over the next decade or so, they've become dominant in waterproofing. So now they are a double-barreled compounding machine. They have dominance in adhesive and they have dominance in
roofing chemicals.
In roofing chemicals. And together, the result of these two engines firing is they've compounded 1000x in the last 20 years, right? So that's the second type of skill. The third is to say that, hey, I don't have adjacencies or I've maxed out on the adjacencies. And now the time has come for me to now go and buy businesses in unrelated sectors. And there, the skill set is an even tougher ask. That's where I think the Indian promoter actually finds the going really tough, where the Buffettian kind of allocation, where he's able to have a freight company, a private jet company,
and an insurance
company, right? That sort of capital allocation in India, we've seen promoters have a really tough time with. They get some right, they get some wrong, but I haven't seen a promoter with a hit rate of more than 50% when they start buying lots of businesses outside their adjacency area. Adjacencies seem to be an area where they still know what they're doing.
Right.
Once it goes out of adjacencies, it seems to be a complete sort of monkey throwing darts exercise.
Right. Okay. So you were talking about ROC. So let me ask you a little bit of a technical question, right? So all of us talk about ROC, especially portfolio managers, and for our viewers, ROC is nothing but earnings before interest and tax divided by capital employed. Why don't we look at ROIC as investors? Because ROIC is basically NOPAT, that is net operating profit after tax divided by investment capital. So now, I always thought that ROC was a useful metric when you're comparing businesses within a sector. And as portfolio managers and from your consistent compounding approach, you are not really looking at businesses within a sector. You are looking at businesses, across market kind of investment opportunity. So why do we keep, why should we not look at ROIC and why do we look at ROCE?
So Sashi, part of my job is to sit across the table from promoters and chivvy them on and nudge them on to deploy surplus capital. Right. So in that regard, if I use ROC and the ROC is low, and I write about promoters with high ROC, I effectively am
nudging them towards better capital allocation.
Right. Okay. So this has actually worked. In our books where we write about companies with good ROC, it deeply hurts promoters whose ROIC is actually pretty decent, but because they hoard it up on surplus cash, their ROC is weak and they end up sort of having almost soul-searching discussions on why did I have so much extra cash. So that's the reason.
Why didn't I at least return it to my shareholders?
That's right, yeah. So our point is either return money to us or deploy it, sir. If you can't do either, you're just hurting yourself and hurting us, right? And hence with my sort of promoter persuasion hat on, I keep using ROC rather than ROIC.
Right. Okay. So long as you're mastered as to what to buy, now I just wanted to ask you about when to buy, because I think this discussion would be incomplete without that.
Yeah.
So is there any merit in trying to sort of time the market, trying to figure out when to buy? can you actually rely on, say, relative P multiples to decide whether, this is cheap, this is expensive, it's the right time to buy this kind of a company? Is there any merit at all in that?
Yeah. So this is an area where even we are trying to improve our skill set here. At its simplest level, it's easy enough, and we've got it right most of the time. You buy a great company, and provided you stay patient for, say, 3 years or so, it will give you at least the return on capital, at least compounding of 14-15% or better, right? Now, the challenge in that we faced is, given the intensity of the bull market in India over the last 2 to 3 years, even people like us who were reasonably, what should I say, unfussed about when we buy, over the last couple of years, valuations have screamed through to such insane levels that even we've realized that we can't do that anymore. That if you were to buy a great company at 120 times, you could have a challenge on your hands as the company's valuation multiples normalize to, say, 120 to 60 times, right? So one of the things that we have tried to sort of come to terms with is that, given that profitability is becoming a little bit more democratized in India, and I talk about this some more in the final chapter of my new book, Behold the Leviathan, given that profitability has become somewhat more broad-based and the market is throwing up more good companies in hitherto undiscovered sectors, if you can buy high-quality, well-run franchises, when the sector is unloved or undiscovered, then these risks of buying a great franchise but at a crazy valuation, those risks get mitigated somewhat, right? And that's something that we've worked very hard on in the last couple of years in our mid-cap.
So in a raging bull market, looking for cheap stocks does make sense,
right? In fact, it's the only way you can buy great companies in a raging bull market. Because if you said, I want to buy great stocks in a raging bull market, well, you're probably the 5 millionth person to have said that, and therefore you might not be the guy who makes a lot of money. Whereas if you say that, look, it's a raging bull market, the economy is in reasonably good shape, why don't I go down the market cap order and look for example, look for companies in providing maternity and gynac and obstetric care to women in South India, right? So choose a theme which resonates with you. So prosperous women, South India, prosperous part of the country, niche play, obstetrics, gynecological care, and see if you can find a company who's operating in that specific niche area. And if you're able to get there before other institutional investors have arrived, you have a good chance of making a good return.
So let me go back to my first question, because you didn't answer that. The first question that I asked you, I talked about time in the market, and you said that, stay invested in the market for the long time. But very often, people give you money to manage, and they don't have the same kind of time horizon that you have. So how do you sort of synchronize those expectations?
So I think two aspects to it. One is we spend a lot of time writing books, doing webinars, writing newsletters to communicate this point of view that however hard we work, there will be years in which our style of companies, high quality companies, will be pounded. So 2022 was such a year, whether it was me, other friends of mine who do high quality investing in India or America, generally 2022 was a bad year for investors like us. So Terry Smith in the UK, Lindsay Trade in the UK, my other friends in America who do high quality investing. 22, the Federal Reserve hiked rates by 500 bips. And high quality investors have their head handed to them, right? So we try our best to communicate this rationally, that if you look back, there will be year and a half, sometimes 2 years, where our style of investing takes a backseat, and if you at that juncture bail out, then you miss out on the next 3-4 years of decent returns. But leaving that aside, the other measure that we have sought to implement reasonably successfully, if not perfectly, the other measure that we've sought to implement reasonably successfully is that when we go through brilliant years where we are compounding 30, 40, 50%, we have sought to put in place risk management measures where we take cash off the table on our biggest winners, right? That's something I didn't do in 2021, and I paid the price for it in 2022. Now that we've lived through that journey, if we see, say, some of our stocks, some of our investee companies, profits are rising 20-30%, but share price is rising 70-80%, we take some cash off the table and de-risk the portfolio so that if a client does lose his nerve, he takes home a decent return, right? I've realized that beyond a point, however many books we write and webinars we do, we can't sort of control the minds of thousands of people out there, and that's our client base. But what I can do is make sure that in years that our portfolio is doing exceptionally well, on those specific big blockbuster winners, we take some cash off the table so that the client, if he were to redeem in a difficult year, goes home with a decent outcome.
So today, many high net worth individuals need to make a choice as to whether the investment vehicle that they choose is, a mutual fund scheme. And a mutual fund scheme provides you diversified risk options, for a wider range of investors, right? From the smallest investor to a reasonably, high net worth individual. Or you have PMFs offerings that, allow you to personalize your portfolios and, tailor make them to what you think are your requirements. Or you could go to AIFs because they offer you, non-traditional investment options. So how does an HNI actually, what does he need to keep in mind while making this choice? Because very often, you got at one point of time, you had these big businessmen who are basically the HNIs, but today you have a whole set of, the new age Indians who are, techies and, in a lot of new businesses, startups who've got, sort of money that they need to invest. And how do they make these choices?
Sure. So I think first thing to realize is all of these are wrappers. AIF, mutual fund, PMS are wrappers. And in each of these three classes, you have good fund managers doing a good job, and in each of these classes, you have bad fund managers doing a bad job. So I haven't seen any data. I'm sure there are different people who will provide different cuts of data on this, but I haven't seen any data which suggests that systematically PMS managers are better or worse than MF managers are better or worse than AIF managers, right? So there is no such thing that if you bought one or the other, you do better automatically. Therefore, what you have to do as an investor is figure out who's a good fund manager given your mindset. So if you are a trigger happy, short-term oriented investor and you choose someone like me, whether I run a mutual fund or an AIF or an PMS, I'm afraid I don't think it'll be a happy association, right? If you want returns in 12 months and that's all you can commit to, then I don't think I'm your kind of investor. But there are other investors in PMS or in MF and in AIF who can say that they aspire to give you strong returns over 12 months. And that's a marriage made in heaven, therefore, right? So understand what you want as an investor and look for a portfolio manager or a mutual fund manager who can give you what you want, right? That's the first piece I think we need to recognize, right? The second aspect is churn. If you think you want a high churn, you like a high churn fund manager, you believe that the world is changing. Right. You believe that the world is changing every day. Trump coming in is something else. Maharashtra elections is something else. A good monsoon is something should also be acted upon, and India's Test cricket results in Australia should also be acted upon. Then a PMS is going to be a bad idea for you, because the way the capital gains tax regime has now been constructed in India, if a PMS is high churn, right. If a PMS is high churn,
the tax incidence is on
that tax incidence, it will come on you, right? Correct. And therefore, if you want a high churn strategy, AIF and PMS are not the way to go. Consider a mutual fund manager. And again, it's a question of personalities. There are some people who believe that there is something new happening in the world every day. It should be acted upon by my fund manager. But therefore, from a tax perspective, you naturally have to gravitate towards a MF. If on the other hand, you believe in what the late great Rob Kirby calls coffee can investing, which is buy a bunch of great companies and by and large let them run for long periods of time, in our case 4, 5, 6 years, then a PMS is actually a perfectly decent way for you to go about investing, and then the tax incidence is not as material between MF versus PMS. So your personality and preference should be aligned to the fund managers, and your time horizons should be aligned to the fund managers. Short-term horizon, short-term oriented investors are far better off doing MFs than PMSs.
So how has the PMS industry evolved in India? If you compare it with how the PMS industry has evolved in the US and how it has evolved in Europe, how has it evolved in India? Because I think it's still very nascent, if I'm not mistaken.
If you look at in terms of size, Sashi, I think in terms of active equities managed by the PMS industry, will be roughly a third of the active equity MF piece, right? Now, many of us in the PMS industry don't think that's such a bad outcome. But again, you're right.
So how does this compare with, say, the US?
So in the US, something like 40% of actively managed equities sit inside PMS wrappers, right? So they call it SMAs, segregated managed accounts. In fact, we are also SEC regulated. Marcellus is SEC regulated. And in fact, all the money that we manage for our North American clients sit in these segregated managed accounts, right? And one of the reasons I think SMAs have been so popular in the Western world, but less so here, is the ability to get tax benefits, tax shelters, the ability to get flexibility in terms of combining derivatives, commodities, stocks, bonds inside a tax advantaged SMA. I think that piece we haven't yet got in India. I hope our country creates that. The NPS is a wonderful product. I'm an NPS user. PMS is a good product. I am a PMS investor. But I think the combination of doing your retirement planning inside a tax advantaged PMS wrapper, I think that coming together hasn't yet happened. I think if it happens, then I think it will be the time where we take off and become like America, where 40%.
But even in terms of numbers, I think we must be far behind, right? Because in India, you have, I think, 400 PMS firms and, just close to around 1,000 odd equity strategies and.
So very interesting point you make there, right? So if you assume for a minute that we have something like, say, 30 million middle class families in India, right? We have 300 million families in the country as a whole, but assume 30 million are sort of middle class, right? The MF folio count is through the roof in that context. I think MF folios are now north of 100 million, right? Demat account numbers are also through the roof, 170 million Demat accounts, right? So it's very strange. If you have 30 million middle class families, then there are way more MF folios and way more Demat accounts. In that context, the PMS industry is actually quite small, right? I don't think we have any more than, I think, a few million. We probably have 2-3 million PMS investors, right? I think that piece, I think, is because we as an industry in PMS have not quite been able to sink into the retirement planning construct, which I think is the fundamental need of middle class families. And part of the reason for that is this tax issue, which hasn't been taken care of.
So if I were an investor who wanted to look at a sort of putting my money into a PMS, you've got these investment approaches and investment strategies. How do I, because I need to decide, as you were telling me a few minutes back, as to what is best suited for me. As a PMS distributor, I mean, does he have a process of trying to identify the needs and the risks that or do risk profiling or a needs analysis of potential investors, and then suggest to them specific strategies that could suit his personality, because you use that word personality. So how does it work for an investor?
So to give credit to both the regulator and to the PMS industry, the PMS distribution piece has now been formally licensed. There's an exam that PMS distributors need to pass, much like mutual fund distributors. So there's a qualification, there's an exam, and I think a better quality of personnel has now come into the distribution ecosystem for PMS. Now, both the PMS provider and the distributor ask these questions about, what is your risk appetite? Can you live with a 20% downside, 30% downside, etc. Right? They ask these questions, they formulate a bunch of questions, and investors religiously answer them, and we classify them into high, medium, low. But I think where the flaw in the process lies is when the market is running up, right? When the market is running up, I find miraculously everybody becomes a high risk investor, right? Even the most timid investor has the heart of a lion in a market and is willing to deal with enormous downside risk in theory. And that same investor with the heart of a lion, redeems as soon as the portfolio drops 20%. Right. So in India, 20% drawdowns at the market level and at the portfolio level are actually reasonably frequent. So the flaw in the way I think we go about doing this high, medium, low as an industry, whether as distributors or as manufacturers, is there's a lot of the recency bias in that. And in a bull market, everybody is high risk, and in a bear market, nobody wants to actually invest, as you can see from where I'm.
So is this the fault of the investor, or is this the fault of the distributor, this inability to understand risk or explain risk, either of the two?
I think it takes two to tango here. I think we all delude ourselves, the distributor obviously and a manufacturer, you want to build more business. It's easier to build business when the market is bullish, when people are feeling good about life. So I think we also, we as manufacturers and as distributors fall into that trap. As I get older and I lose more of my hair watching lots of investors come in the bull market and then leave at the worst possible juncture, I've become a little bit more reticent to sign up lots of clients in raging bull markets, and I've become that much more keener to sign up clients when things are not going so well. It's a challenge to do so, but in course of time, we will figure out a way to do so. An investor who we've learned a lot from, right, is Nalanda. So Nalanda Pulak Prasad in Singapore has created this remarkable system that it's up to him to draw down his investors' capital. So investors, they say, if you want to become an Nalanda client, you sign a contract, but when Pulak Prasad will take your money is at his behest. And that's one way to control this behavioral bias. We haven't been able to bring this to India yet, but I think someone of Pulak's mindset and ilk will, I think, bring this, and I think that'll be a fabulous innovation.
So, just taking this argument a little further, this performance benchmarking itself.
Yes, sir.
How many of them actually understand, how this benchmarking works for PMS strategies? Because you have a set of 3 benchmarks you can choose from. You're tagged to a particular strategy. That strategy is then tagged to a particular benchmark. And by the time the investor gets to understand this whole damn thing, the markets have anyway moved 20%. So he decides that, I don't know whether I've done well.
So,
and more importantly, how do you make inter-firm comparison? Because, everybody's got a different strategy. Everybody could be tagged to a different benchmark. So how do you make that inter-firm comparison if you needed to make that?
So in the investor's defense, I'll say that everybody now, right now, everybody in India that I meet is acutely aware of the index, the benchmark. Right? I think that's a step forward. 10 years ago, I'm not so sure this was as widespread. Awareness of the Nifty, awareness of where the market is, how have you performed sort of relative to the market. I think that sort of awareness is now ubiquitous, and I think that's a big step forward, right? Where I think it gets more challenging, as you're alluding to, is if the benchmark's risk-reward characteristics are fundamentally different from my portfolio, say my portfolio is way more concentrated than the Nifty, but also my portfolio has a few small caps in it. But since SEBI only allows me either Nifty or BSE 500, I'm using the Nifty as a benchmark. If the benchmark's risk-reward characteristics are very different,
it's somewhere in between, for example.
And yet the client is insisting upon using the benchmark as a comparison, that's where I think the challenge is more tricky. It's even trickier if multiple PMS portfolios have to be compared because you're comparing apples with oranges. Now, there are, I think, not 200 family offices in India. Family offices tend to employ clever, highly qualified people to do this sort of work, and they'll have drawdown analysis, Sortino, Sharpe ratios, and they might be able to turn apples versus oranges into something more akin to apples with apples. But for the average investor who doesn't have this sort of computational resources, it is tricky to compare PMS performance across multiple PMS providers.
And talk about performance itself. You need to report performance as a time-weighted rate. Rate of return, or you need to report it as an XIRR. So how do sort of investors get their head around this?
Right. So this is a tricky subject. If you ask me, till SEBI standardized performance calculation, this was done in the SEBI PMS regulations in January 2020. Incredibly, Sashi, till that point, there was no standard way of calculating and reporting performance, right? So SEBI's TWRR directive, I think, was singularly helpful. It directed all portfolio managers to calculate performance the same way. Therefore, the reporting of that has become standardized. I think it's a real challenge to.
So one is standardization, Saurabh, but how do investors get their head around, what does TW
So I'll give you the
actually mean?
The happy scenario. If an investor invests once and then say 3 years later you're reviewing performance, that's explainable enough. You show them year 1, year 2, year 3, and you show them the TWRR. The challenge is if an investor is constantly putting money in, taking it out, and you show them an XIRR, then that's actually very hard for the human mind to grasp. I haven't been able to figure out a simple way to do this, especially if it's a video call on which you're talking to the investor. And you can see the even deeper challenge, right? The investor will put more money in when the fund performance peaks.
Is at peak,
right? And he'll take money out when the fund performance craps out. Given that typical profile, the XIRR will be lower than the TWRR, right? And people, an XIRR in a way is a more realistic representation of the money he's made, right? Because he's actually
takes care of all the cash flow.
That's right. So he's misallocated by coming in when the going was hot and by getting out when the going was actually weak.
But he thinks that you have underperformed.
That's right. So that's the one of those trickiest conversations to have in portfolio management,
Right.
where the TWRR is here, the XIRR is here,
Yeah, right.
because the investor has made some bad calls on his own account,
Right.
because of misunderstanding when to invest. And you can't really blame the client,
Right.
because that's how human psychology is, and
Right.
yet you have to explain the situation. So if you or anybody who watches this video has a solution on how to help investors swallow this bitter pill,
Yeah.
I'd be the first buyer of that bitter pill.
Right. You've drawn inspiration from Robert Kirby. You were mentioning him a few minutes back,
Yes,
and
sir.
Peter Thiel. So just a quote that I came across, of Robert Kirby, where he says, "I think you have to be an undying optimist,
Yeah.
and perhaps a Pollyanna."
Yeah.
And I think Pollyanna comes from Eleanor Porter's little kid who was a cheerful little kid in one of her
Okay.
early writings. So somebody who's excessively cheerful to enjoy and be successful at managing common stock portfolios over long periods of time. And my question to you is, what do you think are the attributes required of a portfolio manager? I mean, you can be an eternal optimist, but is that enough to be a good portfolio manager?
I think what Kirby was referring to, I suspect, right? And I didn't have an opportunity to meet the great man. I wanted to meet him. I wrote a book based on what he did, but by the time I got around to finishing the book and speaking to his erstwhile colleagues at Capital, the great man had passed away. I think what Rob Kirby was getting at was, it's not just optimism in the sense that you wake up in the morning and you convince yourself.
So all's well with the world.
That's right. Yeah, I think that sort of optimism is also good, but I think the optimism he was referring to is, even though the going is rough, say for the economy or for your portfolio, even though the going is rough for the economy or for your portfolio, you maintain your sort of clarity of thought, you maintain your poise, and carry on doing your day job, whether it be finding new investment opportunities or rationally assessing the current portfolio. Right? That is a essential skill the world over. It's easier to be like that in the Western world, right? So I lived in the West for 18 years. I've lived in India now for 17 years. It's easier to be like that in the Western world because exogenous forces buffet you less in a developed economy, right? There's less volatility, less noise, and therefore it's easier to stay in your equilibrium,
right,
in a Western setting.
Equanimity, as they say.
Equanimity. It's easier to maintain equanimity in a Western setting. In the Indian setting, where we go from extremes and we have a volatile political setting and a economy which is vibrant, but it can also go through 2 to 3 really rough years. It's easy to say, my God, the sky is dark, I'm going to batten the hatches, have a cup of hot chocolate and stop talking to everybody, right? And that temptation is I think to be avoided in India, because exactly when the sky is dark and everybody else is throwing in the towel, India tends to give you the best opportunities.
But for a person like you who is essentially a stock picker,
yes, sir,
isn't being a skeptic also important?
So you ramp the skepticism up when everybody else is feeling that we are on to a really strong secular bull run. So whenever I hear the word secular bull run, something inside me says it's
time to become a skeptic.
That's right. So to be honest, for middle class Bengali intellectuals, skepticism is never a challenge. It comes to us naturally.
It's part of your genetic makeup.
That's right. The optimism piece has to be a trained reflex.
Yeah. So the other kind of quotation I had was from Peter Thiel, who I think is somebody else that you've looked up to. And, in his preface of 0 to 1, which is a book I think most of us would have read at some point of time, he says every moment in business happens only once.
Yes.
The next Bill Gates will not build an operating system. The next Larry Page won't make the search engine. And the next Mark Zuckerberg won't create a social network. So if you're copying these guys, you aren't learning from them. So given that you're such a prolific writer, then how do you learn? I mean, part of learning is also copying, isn't it?
So it's a beautiful point that Thiel makes, and that's why I'm a big Thiel fan. There's a video called "Competition is for Losers." It's a 1-hour video on YouTube, and I think it's a riveting read. Now he's remarkable to listen to because he's a very original thinker.
So what did you say the top video was titled?
Competition is for losers.
Competition is for
just
losers.
Go to YouTube and just put competition for losers. Epic 1 hour video. Effectively 0 to 1, but in a 1 hour video form, right? Now, one way to understand this, right? And courtesy Thiel, I ended up reading up on a guy called René Girard. He's a French philosopher who taught in Stanford for 30 years, right? And he espoused a line of thinking which says that we all mimic each other, right? We suffer from what's called mimesis. Every desire, every need, every wish fulfillment that we have is because other people around us have done that, right? And if you follow that strand of thought, you realize that the original thinkers are those who don't have these mimetic desires. Right? If I want to write books because my friends and relatives have said wise people write books and for you to become a celebrated author is the best thing in the world, then I'm suffering from mimesis. If on the other hand, I write books because that's how I believe I find it easy to relax, and rather than watching movies on long flights, writing relaxes me, then that's not mimesis, right? So if you take that line of thought into business, look for thinkers, whether it's in business life or in your personal life, look for promoters, thinkers who see the world in a fundamentally different way to other people and who don't suffer from this need to do what others are doing, right? And often I find that the best promoters demonstrate these characteristics, right? So if you say the promoter has to do something brand new, completely alag, different, I think that's a little too narrow. But if the promoter thinks about a conventional industry utterly differently from other people, I think that's the kind of promoter you're backing. So just to take a specific example, back in 1996, when Sanjeev Bikhchandani started InfoEdge, right, or started Naukri.com. Initially started Naukri and then he took the cash flows and started doing VC investing. So if you look at Sanjeev Bikhchandani's profile, where he used to work in an FMCG company, he quit that with his own money, became an entrepreneur, set up employment classifieds online in India in the mid-90s before the dot-com boom, then took that money and started doing sort of seed investing, then set up a VC fund inside a listed entity. Every element of that man's journey demonstrates originality of thought, almost a decade ahead of other people demonstrating similar behaviors, right? That sort of promoter, I think, is worthy of not just investing in, but that line of thought, the behaviors are very interesting, right? And it's very difficult to be that. The challenge with all of this is it's very difficult to be an independent thinker. Most of us, as René Girard said in that remarkable book, Things Unknown Since the Beginning of the World. René Girard's remarkable book is Things Unknown Since the Beginning of the World. He says most of us suffer from mimesis. Right. We all aspire for the same things as everybody else.
Saurabh, congratulations on your new book, Behold the Leviathan. And there are two stories in that book which sort of particularly struck me. The first story was, the one you narrated from Gurcharan Das's experience of, a little gentleman from Maharashtra called Kawade who joined his company and then, grew on to do a lot more, significant things in the company and in life. That's really the new aspirational India which we are seeing today.
Yes, sir.
And the second story was about this train journey that you had from Boston to New York towards somewhere at the end of your book, and your chance meeting with a designer of music systems, if I'm not mistaken, and stereos, where, she said that there was an unusually clever team of coders from Pune who were doing all the complicated and smart stuff for her.
Yeah.
Right? Which is actually the new rising intellectual power of India. So you, in the course of writing this book, right, have met many sort of thinkers and policymakers to sort of put together these ideas. So could you tell me a story or two of what is not there in your book, which would possibly make it into your next book? So at least we know we have a preview of what's coming next from all those interactions, of a few of those interactions that you had.
Will do. So look, the reason we wrote Behold the Leviathan, the unusual ride of modern India, was over the last 3 years I've realized that somewhere around 21, the Indian economy changed fundamentally. There's a lot of data that we'll provide in our next book on this. But whether you look at India's stock market relative to other emerging markets, whether you look at corporate profitability in the top 70,000 companies in India, growth in corporate profits relative to history, 2021 is a sort of inflection mark. And I think a decade from now, Sashi, a lot of time will go into, a lot of people, scholars will try to figure out what exactly happened in 21 for profitability and share prices to inflect like that. But
so compared to the 90s moment, how is the 20s moment?
Lovely. So yeah, so 91 was an inflection point.
Right.
For reasons that we still don't fully understand. 2021 is also an inflection point, right? Now, in Behold the Leviathan, what we have highlighted as 5 forces which we think are fundamentally different from history but are not fully appreciated. First is women. We're providing a lot of data in the book that women are now way better educated and way wealthier. They have more money in the bank, they have more money in mutual funds than men, and we're providing the data in the book. Secondly, the rise of a newly educated elite, people who are not IIT, non-IIM, not overseas educated, they now run the core of corporate India. The main corporate chieftains and boardroom directors in India are no longer the erstwhile educated elite. The erstwhile educated elite are still there, but they're a fading force. A new elite has come through with very different points of view on how businesses should be built and run. Without any bias against any specific college, the new IS officer is a graduate from a small town in India typically, right? And the third is the rise of South India. Quarter of the population, but 2/3 of the GDP growth is now South India. So we pointed out 5 forces which are fundamentally transformational, and our submission in the book, in Behold the Leviathan, is these forces sort of gathered pace over the last 20 years, but have somehow now become far more forceful than they were, say, 5, 6, 7 years ago.
Sure.
Now, in line with that, right, what we are also realizing, and this is an area of work where we need to do way more research, is just as the use of technology is becoming widespread, I think technology is creating new sources of earnings and employment in India that we don't fully understand, right? So everybody sort of, everybody and their mother, father now have a story about said relative who lost their job because automation or AI kicked in and the person was thrown out and the job was automated. That's easy now. That's called the substitution effect, right? But there's also a complementarity effect. Technology is creating new forms of employment and earnings, which I think are less than visible. So here's a factoid, right? There are something like 1 million Indians now earning a living on YouTube, where they earn between 1 lakh a month all the way up to 10 lakhs per month. Right? 1 million Indians is a big deal, right? 1 million Indians earning a living on YouTube. And as social media becomes even more powerful at the expense of conventional media, these numbers are going to rise, right? Similarly, friends of mine who are specialists in cybersecurity, they say that the largest constituency of people on the dark web are Indians, right? And remember, if you're operating in the dark web, you are going to be earning in bitcoins, right? So that those earnings from hacking, from all sorts of naughty activity on the dark web, those are going to be in bitcoins. They're not going to show up in GDP or employment data, right? So the rise of technology, the rise of low cost broadband, the rise of 10 million graduates a year, many of whom are not getting jobs, means that these new alternative sources of employment and earnings is actually quite a big deal. But there is zero research and no data, and hence I think this is a fertile area for us to get stuck into and understand what are the slices of opportunity that we as investors could tap into as this ecosystem broadens out.
So, reminds me, before I read your book, I also read William Dalrymple's, The Golden Rule.
Yes, sir.
And this put so much into context when I read that book and I read this book, simply because that is where the continuum is. But you still haven't told me that one story, at least, of some of the interactions that you had with your policymakers. Those 2 factoids were very interesting, but the policymakers, which sort of give us a sense as to what next.
So I think the AI piece will clearly be a massive area. It is reasonably clear that the India Stack 1, which is Jan Dhan, Aadhaar, Mobile, UPI, that's been successful. But it's also clear that if AI is not overlaid onto this, the challenges we have around the population being largely in the north and the east, but the jobs being in the south, is not going to get resolved. Similarly, we have an explosion in illness, in specifically in hypertension and diabetes in rural India. Those people don't have a lot of money, but they're falling ill as they are rich enough to consume lots of sugar and oil. And for mass illness to be cured, again, AI will have to come into play.
So policymakers tend to believe that AI will have to overlay the India stack to make it more relevant.
That's right. I think
to come.
Nandan Nilekani and his not-for-profit that he and Rohini Nilekani and Shankar Maruwala run X-Step, they've laid out this point of view that there's the India stack one. AI can be overlaid. IIT Chennai has created tools called Bhashini, which can operate in a multitude of Indian languages. What's now required, what policymakers now need is a group of people to put the training data together. So, for example, if a Mizo girl, 17-year-old Mizo girl about to finish her class 12, she wants to study physics at the Indian Institute of Science but doesn't have the money, hence needs an internship.
Right.
She will speak into her phone, into her AI engine. That AI engine needs to find her the other end of the trade, which is an employer who's willing to give an internship in Bangalore in return for which they pay her college fees. Right. But the training data needs to go in, the bots need to be trained, money will have to be spent on that. Then you need a GPU burn, right? Every time this query is put in, a GPU will be burnt. Someone has to fund that, and finally, all of this has to be publicized, right? So policymakers, I think, have a big task. They know that this is the challenge ahead. How they fund it, how they coordinate this, I think will have a decisive impact on public welfare outcomes over the next decade.
You know, the Oxford Dictionary word of the year this year was manifest.
Wow, okay.
Right? And manifest basically means willing something into existence or dreaming something into existence. Maybe the title of your next book should be, The Manifestation of India.
Lovely. Thank you.
Thank you so much, Saurabh, for spending time and talking to us.
Thank you, Sashi. The privilege is all mine. Thank you, sir.